Welcome back to the Deep Dive. Today, we're really tearing into a topic that touches almost everyone, your credit score. It often feels a bit mysterious, right? But it's not just some number floating out there. It's like the key to getting better rates on, well, everything. Cars, homes, even the credit cards you can get.
Absolutely. It has such a broad impact.
Yeah, and we've just finished this fantastic deep dive into elevating your credit score, a strategic guide, and honestly, it's packed with practical stuff. I'm excited to unpack it.
Me too.
Our goal today is simple. Cut through the confusion, give you a clear roadmap, understand it, boost it. Okay, let's unpack this.
And what's fascinating here, I think, is how just a few core habits can really shape your whole financial future.
Yeah.
Like you said, it's not just about borrowing. It kind of reflects your financial responsibility overall.
Right.
And it might seem super complex, but the basic ideas, they're actually pretty straightforward once you see what drives the score.
So let's break down those drivers then, those building blocks. What actually makes up a FICO score? Because that's the one most lenders use, right?
That's the big one, yeah. FICO is dominant, although there are others like Vantage Score, which look at similar things.
Okay, so FICO, what are the pieces? Our analysis showed 5 main things. Payment history, that's huge, 35%.
35%.
Yeah, the biggest single factor.
Then there's amounts owed, or credit utilization, that's 30%.
Right, almost as big. So between those two,
That's 65%.
exactly, 65% of your score decided by just those two things.
Wow. Okay, what else? Length of credit history is 15%.
How long you've been managing credit?
Then new credit inquiries, that's 10%.
Applying for new stuff?
And finally, credit mix,
Yeah.
also 10%, the types of credit you have.
And if we, connect this to the bigger picture, you see immediately why those percentages matter.
Yeah, the 65%. Right. Payment history and utilization, they're weighted so heavily because they directly show lenders two key things. One, will you pay on time?
Makes sense.
And two, are you stretching yourself too thin financially?
Okay.
Understanding that weighting tells you exactly where to focus first, tackle those top two, and you're dealing with the bulk of your score. It's like building a house. Got to get the foundation right.
It feels almost obvious when you put it like that, doesn't it? Pay on time, don't owe too much.
It is pretty intuitive, yeah.
But thinking about impact,
Mhm.
if someone needs to see a change maybe a bit quicker, which of those two, payment history or utilization, might move the needle faster, even slightly?
That's a really good question because while they're both critical, credit utilization can sometimes shift things more immediately.
Okay.
I mean, changing your payment history takes time, right? By
Yeah.
definition, it's history.
Right, you can't change the past overnight.
Exactly. But say you have high balances on your cards and you manage to pay them down significantly.
Yeah.
You could see a bump in your score relatively quickly, often within just a month or two, whenever the lender reports that new lower balance.
Interesting. So that's potentially a quicker win.
Potentially, yes. But, and this is a big but, payment history is still the absolute bedrock. Long term, nothing beats consistency there.
Got it. Bedrock first. So let's dive into that number one factor, the 35% powerhouse.
Yeah.
Paying every bill on time, every single time.
This is it. Foundational.
Yeah. The takeaway from our deep dive was crystal clear. Never miss a due date. It's paramount. Late payments hurt, sometimes badly. On-time payments help consistently.
Right.
Practical tips. Set up automatic payments or calendar reminders, whatever it takes. Just make sure you pay at least the minimum amount by the deadline.
Minimum is key by the deadline.
Definitely. I wish I'd grasped that earlier. Had a few closed calls myself. And if you do have accounts that are past due,
Get them current ASAP.
right, get them current as soon as possible. Because while those late marks do hurt your score, their impact does lessen over time, especially once you start paying on time again.
Precisely. And think beyond just the score for a second. What does a perfect payment history say about you?
Reliability.
Reliability, yes, but also, responsibility.
Yeah.
Foresight. These are qualities lenders really value, especially when things feel uncertain economically.
It builds trust.
It builds trust, exactly. It establishes your financial health for the long haul. Lenders see you as lower risk, someone who takes their commitments seriously. It's like showing up for work every day, doing a good job.
Builds a reputation.
Build a strong reputation over time. Same idea with your credit.
Okay, so the win of paying is absolutely fundamental. But the how much we're using. That's the other huge piece, right? Tell us about credit utilization, that 30% chunk.
That's right. Credit utilization ratio. It's basically how much of your available credit limit you're actually using at any given time.
Okay.
The golden rule, the sort of rule of thumb we found, is try to keep your usage under 30% of your total credit limits across all your cards combined.
Under 30%. And lower is better.
Lower is definitely better, yeah. So, for example, if you have one card with, say, a $5,000 limit, you'd want to keep the balance on that card below $1,500. That's 30%.
Okay, simple enough. But what if I have multiple cards?
Good point. You look at the total. So maybe one card has a $5,000 limit, another has $2,000. Your total available credit is $7,000.
Right.
So your goal is to keep the combined balances on both cards below 30% of $7,000, which is $2,100.
Got it. Combined balances, total limits. Why is this so important? Why does high usage hurt?
Because high balances, especially when they're close to your limits, can signal to lenders that you might be financially stretched, overextended.
Like you're relying too much on credit.
Exactly. It looks riskier. And that hurts your score.
Okay, I get why keeping balances low matters, but, I can hear people thinking, wait, I use my card for everything, for points. How does that work with the 30% rule?
That's a super common question.
And also, let's bust that myth.
Yeah.
You know the one? That you have to carry a balance month to month to build credit.
Oh, that myth. Yes, let's definitely bust that one. Okay, first, the points question.
Yeah.
You absolutely can use your card for rewards and keep utilization low. The trick is when you pay. Most card issuers report the balance shown on your statement to the credit bureaus. So if you charge, say, $3,000 during the month on that $5,000 limit card, but you pay off $2,000 before the statement closing date.
Before it cuts off.
Right. Then the balance reported might only be $1,000, which keeps your utilization for that card at a nice, healthy 20%. Or just pay the whole thing off by the due date.
So pay it down before the statement date or pay in full by the due date.
Exactly. And that brings us to the myth.
Yeah, the carrying a balance thing.
It is one of the most persistent and frankly damaging myths out there. You absolutely, positively do not need to carry a balance from month to month to help your score.
So it doesn't help.
No. All it does is cost you money and interest charges. Paying your cards in full every month saves you interest and still shows you're using credit responsibly. It demonstrates control, not that you need the debt. Lenders like to see that control.
That is a great clarification. Okay, myth busted. Now, let's shift gears a bit. Length of credit history.
Right.
That's about 15% of the score.
Right. Longevity matters.
The longer your history, especially if it's well managed, the better for your score.
Yeah.
So, a key takeaway from our deep dives, those old credit cards, the ones maybe sitting in a drawer with no annual fee, seriously consider keeping them open, even if you don't use them much.
Why is that?
Because they contribute to a longer average account age.
Yeah.
And that looks good to lenders. It shows stability.
The average age of all your accounts.
Right. And when you close an account, especially an old one,
poof,
you lose that history.
And you also lose its credit limit, right?
Exactly. Which could actually hurt your utilization ratio if you're carrying balances on other cards.
Yeah.
Suddenly, your total available credit drops.
So your utilization percentage could jump up even if your spending hasn't changed.
Precisely. It's a double whammy, potentially.
So is there an argument then that, like, if someone has mostly newer cards, but one really old one, even if they barely use it, that single old card is kind of punching above its weight for history?
That's a great way to put it. Is that right?
Yeah, absolutely. That's a fascinating distinction. The age of your oldest account often carries quite a bit of weight.
More than just the average.
It contributes significantly to the average, but yes, having that one anchor account that's, say, 10, 15, maybe even 20 years old, it provides a really long track record.
Okay.
It reflects stability, reliability. It's like having a long, positive job history versus someone just starting out. Even if the newbie is doing great, the long history provides more data, more assurance. Lenders see that long-term responsible use as a safer bet.
That makes a lot of sense.
Yeah.
So hold on to those old no-fee cards. But there's always a but, isn't there?
Usually, yeah.
When might it actually make sense to close an old account? Like, what if it has a hefty annual fee you're not getting value from? Or maybe it just tempts you to spend too much?
That's the practical side, definitely. If a card, even an old one, is genuinely causing problems like tempting overspending or costing you significant fees you don't recoup through rewards or benefits,
then what?
Then closing it might be the right move for your overall financial health. But, and this is crucial, You have to be aware of the potential hit to your score.
Because you lose the history and the credit limit.
Exactly. It could cause a temporary dip. So you weigh the cost of the fee or the temptation against the potential score impact. Generally, though, if it's not hurting you financially, keep the old ones open. Maybe use them for a tiny purchase once in a while just to keep them active.
Like a coffee or something.
Yeah, something small, easily paid off, just shows activity.
Okay, so keep old accounts open. But what about opening new ones? That feels like another tricky area. New credit inquiries. About 10% of the score.
It can be tricky, yes. Every time you formally apply for new credit alone, it can result in what's called a hard inquiry on your report.
Hard inquiry. Okay,
Yeah.
and that's different from checking my own score.
Yeah, it's totally different. Checking your own score, or when a lender pre-approves you without a formal application, those are soft inquiries. They don't affect your score at all.
Good distinction.
Hmm.
So these hard inquiries, what's the big deal?
Well, the main thing is applying for a lot of new credit in a short space of time can ding your score a bit.
Why?
Lenders might see a flurry of applications as a sign of financial stress, like maybe you urgently need access to funds, or you're trying to take on too much debt too quickly.
It looks risky.
It can look risky, yeah. Like someone suddenly asking everyone they know for money. It raises a red flag.
So how much does one inquiry hurt?
Usually a single inquiry isn't a huge deal, maybe a few points off your score, typically, but they can add up. If you apply for 5 cards in a month, that cumulative effect could be more noticeable.
Okay.
And there's that secondary effect, too. Every new account you open slightly lowers the average age of all your accounts.
By pulling down the average we just talked about.
Exactly. So it underscores the need to be, intentional, strategic about when you apply for credit.
So don't just apply on a whim for every offer that comes in the mail.
Please don't. Only apply when you actually need it, and try to space out applications, especially if you know you'll be applying for something major soon, like a mortgage. Avoid applying for other stuff right before that.
Good advice. Be thoughtful, not impulsive. Okay, strategy number 5. This one feels really important, but maybe easy to forget. Check your credit reports.
Yeah.
And fix any errors.
Absolutely crucial, and often overlooked.
You have the right to get a free report every year from each of the 3 main bureaus, Equifax, Experian, TransUnion. And right now, you can actually check them weekly online for free.
Yeah, that's a great benefit currently available. Annualcreditreport.com is the official site.
Right. And our analysis really emphasized reviewing these reports carefully. Look for mistakes, fraudulent accounts you don't recognize.
Things happen. Errors creep in.
Definitely. I heard about someone whose score dropped because an old, tiny utility bill they thought they'd paid years ago got reported as delinquent by mistake.
Ouch. Yeah, that can happen.
It was fixable, but imagine not catching that. Errors like a payment marked late when you know you paid on time, or an account listed that isn't even yours. Those could be unfairly hurting your score.
And you wouldn't know unless you look.
Exactly. So if you find something wrong,
dispute it. Contact the credit bureau directly. They have a process.
You'll likely need to explain the error, maybe provide proof like a bank statement or receipt.
Right. And they're legally required to investigate your dispute, usually within 30 days.
And getting errors corrected, that can actually boost your score sometimes, right? Maybe quite quickly.
It certainly can. If an error was dragging your score down, fixing it removes that negative item. Instant improvement, potentially.
Plus, just keeping an eye on your reports helps you see all your debts in one place, understand your situation better.
And it's a critical tool for spotting identity theft early. If you see an account you didn't open, that's a huge red flag.
So true. It's basic financial hygiene, really.
This really raises an important question, doesn't it? When was the last time you truly reviewed your financial story as told by your credit report?
Good question.
It's not just about the score number. Auditing your own narrative like this, it's a skill. It helps you understand your spending, maybe spot other issues. It fosters an active relationship with your finances, not passive.
Taking ownership.
You have to be your own first line of defense against mistakes. Don't just assume it's all correct. Verify it. That critical thinking can save you a lot of headaches and money.
Absolutely. Okay, final strategy area. What about folks who are just starting out, have a thin credit file, or maybe had some trouble in the past and need to rebuild?
Yeah, building or rebuilding credit wisely.
Our deep dive highlighted a few key tools. Secured credit cards seem like a popular one.
They're a great starting point, often.
How do they work again? You put down a deposit.
Exactly. You provide a cash deposit, usually a few $100s, and that amount typically becomes your credit limit, so the bank isn't taking much risk. Then you use the card just like a regular credit card, maybe for small, regular purchases like gas or groceries.
And the key is?
Pay the balance in full, on time, every single month.
Right. Build that positive payment history.
Precisely. The lender reports your activity to the credit bureaus, just like with an unsecured card. Over time, demonstrating responsible use with the secured card can help you qualify for traditional unsecured cards later on.
Makes sense. What about credit builder loans? Heard of those too.
Yeah, those work a bit differently, kind of in reverse.
How so?
Instead of getting money up front and paying it back, you make payments to the lender, who puts the money into a locked savings account for you.
So I'm basically saving, but it looks like a loan payment.
Kind of, yeah. Once you've made all the payments, maybe over 6 or 12 months, the loan is considered paid off. The lender reports all those on-time payments to the bureaus, and you get the money from the savings account back.
That's clever. Builds payment history without actually giving you debt to potentially misuse.
Exactly. It's a very structured way to establish a positive payment record.
Okay, what else? Authorized users. Does that work?
Becoming an authorized user on someone else's card can sometimes help, yes. If the primary cardholder has excellent credit and a long history, and importantly, if the card issuer reports authorized user activity to the credit bureaus.
Not all do.
Not always in a way that helps the authorized user's score significantly, but often it does contribute something. But there's a big risk.
What gives?
If the main cardholder misses payments, runs up huge balances, that negative activity can show up on your credit report too.
Oof. So you're tied to their habits.
You are. Only do it if you have absolute trust in the primary user's financial responsibility.
Good warning. And lastly, that credit mix factor, the 10%. Does having different types of credit help?
Over the long run, yes, it can slightly help. Having a mix, say, some revolving credit-like cards and some installment loans like a car loan or student loan shows lenders you can manage different kinds of debt responsibly, but it's a minor factor compared to payments and utilization. Don't go taking out loans just for the sake of mix.
Right. Focus on the big stuff first.
Absolutely. Ultimately, the message for building or rebuilding credit is consistent, responsible use over time. Pay on time. Keep balances low if you have cards. Only borrow what you can truly afford to repay.
No magic bullets.
No quick fixes, really. It's about building those solid habits. They take time, but they work, and they steadily improve not just your score, but your overall financial standing. It's a discipline, but one that pays off.
So what does all this mean? Wrapping it up.
Yeah.
It means your credit score isn't set in stone. It's not this fixed grade you're stuck with.
Not at all. It's dynamic.
It's dynamic. And it's largely within your control through these consistent, responsible habits we've talked about. Focusing on these strategies, paying on time, keeping utilization low, holding on to old accounts wisely, being careful with new applications, checking your reports, building credit smartly if you need to. You're not just chasing a number.
No, it's much bigger than that.
You're actively opening doors. Better interest rates, easier approvals. You're building a stronger financial future for yourself.
And maybe think about this. Beyond just the better rates and easier loans, cultivating these strong credit habits, it's really a masterclass in financial discipline, in long-term planning.
That's a great point.
So the final thought I'd leave you with is, how might applying the same level of, discipline, this intentionality, to other parts of your financial life, like your saving habits, your investment strategy, even your career planning, how might that yield similarly powerful, positive results?
Wow. Connecting the dots.
It's all connected, isn't it? It's not just about managing credit. It's about managing your resources effectively and planning thoughtfully for your future. Keep learning, keep applying these ideas, and watch things grow.